Hey everyone, welcome back to MarketSnap. Bristol-Myers Squibb just hit a 52-week high, raised its full-year guidance, and won FDA approval for a brand new class of cancer medicine. And that's exactly why we need to slow down and check the math. Because in pharma, a great pipeline story can hide a brutal patent cliff. So today we're skipping the hype and running the numbers, financials, cash flow, the whole 9 yards, to see if the story actually matches the spreadsheet. Let's set the stage. BMY is up over 40% in the last 12 months, and it's been on a tear recently, up about 7% in the last month alone. The stock is trading right around $67, which puts the market cap at roughly $137 billion. And here's the kicker. The stock carries a beta of just 0.22. That's incredibly low volatility for a large-cap healthcare name. This is a stock that moves slowly, pays a solid dividend, and is now starting to get some momentum. But the big question is whether that momentum is built on a sustainable foundation or just a short-term catalyst pop. For those who don't know Bristol-Myers, this is one of the oldest and most storied names in American pharma. Founded back in 1887, the company has been through multiple transformations, but the modern iteration really took shape after the massive Celgene acquisition. Today, Bristol-Myers is a global biopharma giant with over 32,000 employees focused on oncology, hematology, immunology, and cardiovascular diseases. The CEO is Christopher Boerner, and the company is headquartered in New York. The portfolio is anchored by blockbuster drugs like Opdivo, Eliquis, and Revlimid, but those are exactly the products facing the patent cliff we need to talk about. Let's dig into the revenue picture, because this is where the story gets interesting. In fiscal 2025, Bristol-Myers generated just under $48.2 billion in revenue. The biggest driver by far is Eliquis, the blood thinner, which brought in over $14.4 billion. That's nearly a third of total revenue. Opdivo, the immuno-oncology workhorse, contributed just over $10 billion. Then you've got a long tail. Yervoy at $2.9 billion, Pomalyst at $2.7, Reblozyl at $2.3, and Breyanzi, the CAR-T therapy, at $1.4 billion. But here's what I find really telling. The growth portfolio, which includes newer drugs like Camzyos, Sotyktu, Cobenfy, and Opdualag, is still relatively small compared to the legacy blockbusters. Camzyos did just over $1 billion, Sotyktu under $300 million, and Cobenfy, which is one of the most anticipated launches in the pipeline, only did $155 million in 2025. That's the challenge in a nutshell. The old guard is facing generic competition, and the new guard hasn't scaled up enough yet to fully replace it. Geographically, the U.S. is the dominant market, accounting for roughly $33 billion of that total. The rest of the world makes up the balance. That U.S. TUA concentration is a double-edged sword. It means pricing power, but it also means regulatory and political risk around drug pricing reform. Now let's talk about the earnings picture, because this is where the recent optimism comes from. The second quarter of 2026 was a genuine beat. Bristol-Myers reported earnings of $2.04 per share, crushing the consensus estimate of $1.59. Revenue also came in ahead of expectations, and management responded by raising their full-year 2026 guidance, which is always a positive signal. But let's zoom out to the full-year numbers, because the trend line matters more than any single quarter. In 2025, the company earned $3.46 per share on a GAAP basis. That's a massive recovery from 2024, when they posted a loss of $4.41 per share, a loss driven by massive impairment charges related to some of their acquired assets. And 2020 was another loss year, at negative $3.98. So this is a company with a history of volatile earnings driven by acquisition accounting and write-downs. The good news is that the underlying operations are solid. In 2025, gross margin came in right around 70%, and operating income was nearly $13.7 billion. Net income was just over $7 billion, and the company generated over $14 billion in operating cash flow, with free cash flow of about $12.8 billion after CapEx. That's a lot of cash generation, and that's what's funding both the dividend and the pipeline investment. Let's take a closer look at the balance sheet and the key financial metrics, because this is where the risk profile really shows up. Bristol-Myers is carrying a significant debt load. Total liabilities sit at over $71 billion, against total stockholders' equity of just $18.5 billion. That works out to a debt-to-equity ratio of about 1.9, which is high for a pharma company, though not unusual given the Celgene acquisition financing. The company has about $10.2 billion in cash on hand, and the current ratio is a healthy 1.53. So there's no immediate liquidity concern. But the leverage is worth watching, especially if earnings start to decline as the patent cliff hits. On profitability, the return on equity is a strong 47%, and return on invested capital is about 15.5%. The net profit margin is just under 19%. Those are all respectable numbers for a mature pharma. The dividend is a key part of this story. The current yield is about 3.7%, and the company has been paying and growing that dividend for years. Last year, they paid out over $5 billion in dividends. That's a meaningful return to shareholders, and it's one of the main reasons income investors are drawn to this name. Now let's get into the SWOT analysis, the strengths, weaknesses, opportunities, and threats. This framework is essential for understanding the full risk-reward picture. Starting with strengths, Bristol-Myers has a deep and diversified portfolio. Opdivo and Eliquis are still generating massive cash flows even as they approach their patent cliffs. The company has a strong pipeline with several recent approvals, including the first-in-class CELMoD therapy Zenbexis, which just received FDA accelerated approval for multiple myeloma. The balance sheet, while leveraged, is manageable, and the company generates over $12 billion in free cash flow annually. And the dividend, at nearly 4%, is a significant draw for income investors. On the weakness side, the patent cliff is the elephant in the room. Revlimid has already lost exclusivity, and Eliquis and Opdivo are facing generic competition in the coming years. The growth portfolio is still too small to fully offset those losses. The company also has a history of large write-downs from acquisitions. Remember the $9 billion loss in 2024, which suggests management has a tendency to overpay for deals, and the high debt load limits financial flexibility. Now for opportunities, the pipeline is genuinely exciting. Zenbexis is the first in a new class of drugs called CELMoDs, and early data shows it doubles MRD-negative complete response rates in multiple myeloma. Cobenfy, the schizophrenia drug, has blockbuster potential if it launches successfully. The company is also investing heavily in cell therapy with Breyanzi and in immunology with Sotectu. If even a couple of these hit their full potential, the growth portfolio could transform the revenue mix. And then the threats. Generic competition is the biggest one. When Eliquis loses exclusivity, that's over $14 billion in revenue at risk. Drug pricing reform in the U.S. is another ongoing threat, with Medicare price negotiations potentially impacting key drugs. And there's always clinical trial risk. A late-stage failure can wipe out billions in market value overnight. The company also recently ended its partnership with Cellares on cell therapy manufacturing, which raises questions about their ability to scale Breyanzi efficiently. Let's look at the price action, because the technical picture is actually quite compelling right now. The stock just hit a 52-week high, which is a bullish signal. Over the past year, BMY is up over 40%, and the 3-month performance is up over 16%. The stock has been on a steady climb since the Q2 earnings beat, and the momentum is clearly to the upside. But here's the thing to keep in mind. A 52-week high in a stock that's been beaten down for years can mean one of two things. Either the fundamental story is genuinely turning around, or the market is getting ahead of itself. The low beta of 0.22 tells us this isn't a speculative momentum name. It's a slow, steady mover. So the recent run-up is more likely driven by genuine improvement in the fundamentals than by speculative froth. Looking at the valuation, the stock is trading at about 15 times trailing earnings, which is below the industry average of around 38 times. On a forward basis, it's even cheaper. But those multiples are low for a reason. The market is pricing in the earnings decline from the patent cliff. Now let's get to the part that really matters. What is Bristol-Myers actually worth? We ran this through the MarketSnap valuation model, and the setup is interesting. The model uses forward PE as the primary engine, with a DCF as the supporting check. The confidence level is high, and the reason is straightforward. This is a mature compounder with analyst estimates available, positive free cash flow history, and a stable margin profile. That's exactly the kind of company where a forward earnings multiple makes sense. The model applies a forward PE target of 14 times, which is conservative. The historical normalized multiple for this company is closer to 20, but with earnings expected to decline due to the patent cliff, the model correctly adjusts downward. The terminal PE assumption is 15, which is reasonable for a mature pharma. So what does the model spit out? The MarketSnap fair value comes in at around $65. The current price is right around $62, so the stock is trading roughly in line with our model estimate, maybe a few percent below. The implied 5-year CAGR is only around 1%, which tells you the market is not expecting much growth from here. Here's what drives that valuation. First, the free cash flow conversion is being normalized. The company's 5-year average FCF to net income ratio was over 180%, which is not sustainable. It was inflated by non-cash charges like amortization. The model adjusts that down to a more realistic range of 110 to 120%. Second, the share count is expected to decline at a slower pace than before, about 1% annually instead of 2%, reflecting the recent share issuance and likely slowdown in buybacks. And third, the forward PE target of 14 times is conservative, aligning with the current market multiple and the terminal PE assumption. Now, I need to be clear about something. These are rough model estimates, not precise price targets. Change the assumptions, say a higher growth rate for the pipeline or a different discount rate, and the fair value could swing dramatically. The model could put this stock somewhere in the 50s or somewhere in the 70s depending on your inputs. If you disagree with our assumptions, you can plug in your own growth or discount rate numbers on the intrinsic value calculator at MarketSnap.com and see how the fair value shifts. The key takeaway from the model is this. At the current price, the market has already priced in a lot of the bad news. The patent cliff is baked into the multiple. The question is whether the pipeline can deliver enough upside to push the stock beyond that. All right, let me give you my honest take on Bristol-Myers. This is a classic value and income play with a catalyst-driven upside. The stock is not expensive, the dividend is solid at nearly 4%, and the company is generating massive free cash flow. The recent FDA approval of Zenbexis is genuinely exciting. It's a first-in-class therapy with real potential. But I have to be honest about the risks. The patent cliff is real, and it's coming. Eliquis and Opdivo are the two biggest revenue drivers, and both face generic competition in the next few years. The growth portfolio is promising, but it's not yet big enough to fill that hole. And the company's track record with acquisitions, the massive write-downs in 2020 and 2024, gives me pause about management's capital allocation. Here's the bottom line. If you put $10,000 into BMY today and hold it for 5 years, our model suggests you'd end up with roughly the same amount, maybe around $10,400, assuming the base case plays out. That's not a home run. But that doesn't include the dividend, which adds nearly 4% per year on top of that. So the total return picture is more like a steady 5% annualized. Not spectacular, but respectable for a low-beta healthcare name. The bull case is that Zenbexis and Cobenfy exceed expectations, the pipeline delivers more surprises, and the stock re-rates higher as the market gains confidence in the growth portfolio. The bear case is that the patent cliff hits harder than expected, the pipeline disappoints, and the stock stays range-bound for years. For me, this is a stock you buy for the dividend and the defensive characteristics, not for explosive growth. If you're looking for a low-volatility income holding with some upside optionality from the pipeline, BMY fits the bill. If you're looking for a high-growth story, this isn't it. What do you think about BMY? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one. MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.